All right, all right. Thanks everybody for joining me. Tim Harridge here. We're going to talk about refinancing rental property. I thought I would just lay out the agenda for today. So we're going to talk about something a billionaire told me. We're going to talk about replacement cost. We'll talk about depreciation, closing costs, proceeds, interest expense, and then how to double up your portfolio. The first thing to talk about is when I was running Blackstone's B2R Finance, there was a billionaire that we worked with very closely. And I was talking about flipping houses, selling houses, etc. And he just very, I would say excitedly told me to never sell good property. And you know, it's addictive, the cash that you get from selling houses, especially when you start as young as I did. I mean, I've been doing this for 18 years now, and I'm 41 years old. But when you look back, just in my short 18-year career, if I had kept one extra house a year, good houses, with the appreciation we've had and the discounts I used to buy at, I mean, you're looking at $3 to $4 million in additional net worth that I would have today. And you're probably looking at an additional, $7,000 to $10,000 a month in net cash flow. So it's just one of those things that you look back, you wish you'd kept more. I didn't. It's time to move on. So, in the words of this good mentor of mine, never sell good property. And we'll talk about that on the next slide. So, what makes a good property? I think for me now, it comes down to, obviously there's a cash flow test, but it's more important that you look at the replacement cost of that asset. When you're looking at rental property, specifically with the cost of labor and materials these days, it is hard to build houses for what they sell for. When you look at, every one of these houses that I'm refinancing that we'll get to in a second, every one of them, it would cost far more to build a brand new house in that location than I'm borrowing on the house. And so what happened is when Blackstone got into the Invitation Homes, their house buying operation, they end up in this neighborhood in Southern California. And one of the founders says, oh my gosh, what is that house for sale for? Because it was a foreclosure, obviously vacant and abandoned. And one of the neighbors was telling him, and he goes, well, could you even build that for that? He goes, oh, absolutely not. And so that was kind of the spurring factor that got those guys looking at this. And, it's become a way to think. I mean, look at your assets, look at your portfolio, look at where you're buying, and then just ask yourself, could you build that house for that price in that location? And if the answer is no, then you probably have a good rental investment, right? You have an asset that has room to go up. You have an asset that, obviously you have to look at the cash flow, and as you'll see in a little bit, every one of my loans, well, not everyone, the majority were recently restricted by the cash flow, not the value. So for me, the whole 80-90% of ARV or estimated rehab, etc., I don't think that's as important to me anymore as the financing. And when I look at it, do I feel like it is a good long-term asset? Do I feel like I'm getting it below the replacement cost? Do I feel like it's in an area, a city, a town, a location that is going to be good to own? I don't, and that's just the way I look at it. Now, if you're looking at buying a house above the replacement cost, I don't know. I mean, personally, I say look somewhere else. Depreciation. I hear a lot of talk, and I think there's a lot of people that want to sell you a course about depreciation. And obviously, I'm not a tax advisor, so you should definitely get advice from your own CPA or advisor. But I'll tell you this is my opinion. Play the long game. If you are cramming everything up on the front, right? If you sell anything, you have to recapture. But also, if you're looking at doing this as a retirement asset, if you're looking at having these assets as a long-term wealth strategy, well, it's going to be really hard because you're going to run out of depreciation. If you start componentizing everything, you'll run out of depreciation in year 4, 5, 10, 12, depending on how long you depreciated something. So I say play the long game, just do straight line depreciation, take it out over 27 and a half years. And, then if you're adding a new asset every year, you end up with this compound effect. You may not get the short-term benefit of having, the big, losses, so to speak, on paper. But I think this is all about the long game because, it takes a lot of hustle to build some of these portfolios. It takes a lot of hustle to go out and find houses. And I think after 18 years of this, I'm living proof that eventually you kind of fall out of love with it, right? You'd rather spend time with your kids than run around and try to build your portfolio. So take the long game, play the long game. I recommend straight line depreciation and just, drag it out. But, because once you compound and, if you've bought a house every year for 25 years, you've got 25 houses worth of depreciation in year 26. And, that is going to significantly reduce your net income, taxable income. And, the beautiful thing is on paper, the home may be going down in value, but it's definitely going up in value if you look historically over any 10-year period in U.S. history. I tell the story about I drive my kids past my childhood home, and that my parents bought for $18,000 is now worth $180,000. And every generation says this. It's it can't keep going up like that. The home my grandparents bought originally in Mesquite, Texas in the 1950s, they paid like $5,000 for it. So, and now it's worth 140, 150. So, and everybody talks about the price of gasoline and it just don't be the old guy that looks back and says, oh, I was wrong. One day your kids will be like, oh, can you believe they used to be able to buy houses for $200,000? Now it's $1 million. It's just going to happen. So, the beautiful thing is with depreciation, if you run it out right, it will significantly reduce your tax burden in the critical years of building your portfolio. So I'm just going to give some general thoughts on real estate investing transactions. So number one, for me, I believe that you should pay as many points as you can, as long as you're getting a benefit. Like, you shouldn't just pick a high point lender. I'm not saying that, but as we'll go over in a minute, I like to pay points in year one to buy down the rate for years, for the life of the loan. And we'll go over it and I'll show you some of the real examples that I got to choose from in just a second. But it's important to realize that if you're refinancing rental property, closing costs are a year one expense, right? So you're paying these points with borrowed capital, right? You borrow $100,000 and then you're writing off the points, right? So it's a year one expense. Closing costs, are a year one expense. And you're paying those expenses with borrowed capital. So it's not taxable revenue, right? It's not income. So it's kind of a phantom expense. I mean, you're getting money that you don't pay taxes on, and then you get to pay taxes. I mean, you get to reduce your income by the expenses that are paid with that borrowed capital. Interest expense is deductible in the year paid. So again, it's a steamroll approach for me. It's get that interest on the books, and these are all amortized loans. So, you pay a lot more interest in years 1 through 10, or really 1 through 8. And so what you really want to do is stretch that out, get that interest deduction. Again, it comes off your top line, but someone else is paying it. It's just key. And then you can use the proceeds that are tax-free, remember, to double up your portfolio. Most of these loans don't restrict you on what you use the capital for. And I'll show you kind of my methodology here in just a sec, because what we do, the reason we refinance is if we refinance 5 houses, we end up with enough capital to at least acquire 5 additional assets. And it looks like this last one will probably refinance 5 houses and end up getting 6 or 7 assets. So, and these are good assets, right? We've really kind of honed in our criteria, as you'll see in just a second. So we'll go through a little bit of a case study. These are the 5 houses that I'm currently refinancing. You'll notice that one is we've owned since 2001. It really reflects, my wife owned that before I met her. It really reflects a shift in mentality, because we used to think we wanted to own everything free and clear, right? The entire thing was, ooh, get it free and clear. Ooh, don't pay any more taxes on. And while that was interesting, you kind of start to realize that it limits your ability to grow and scale. So that's what we work on now, is instead of trying to have everything free and clear, we're slowly refinancing our assets so that we can, so we can grow the portfolio using borrowed capital, and responsibly borrowed capital. As you'll see in just a second, we're not over leveraging these houses. So there's a house in Garland, I bought in 2005. That house is, we've already refinanced that once or twice in the last 14 years. But, you see considerable spread in those older acquisitions. And then you have this one in Garland that we bought in 2016. That was a great deal. Man, I met this realtor at a networking event. And it turned into buying a house the next week. And it's a great cash flow property. I really like that house. But you see, there's a considerable amount of equity in it. And that's equity that we can grow with that does nothing but add to our bottom line. So it's just something we do. And then you see this Grand Prairie house that we just bought in, it was May. Now, I messed up a little on the financing on this house, and we'll talk about that in a second. I should have borrowed additional capital on the front end so that I could have refinanced more. But it was just a point to where we were moving kind of fast, and frankly, I made a little bit of a mistake. So, and then you'll see this Farmers Branch house. That's one of the better houses I've bought in the last couple of years. It's just a really good cash flow property. We bought it for $165. We're able to borrow $175 on the front end. So now it's being treated as a rate and term refinance. And we're only in the house for like $180. So we're going to end up having very little cash in this deal. And it's going to be a good one. So let's get into it. So this is the house that I bought in Dallas, or this is the first house. So these go in order, right? So just remember this slide. It shows you, so we're just going to go top to bottom and talk about the way the refinance worked. I ended up getting 5 quotes from different lenders, and then I picked this loan, and there's a reason why, but we'll talk about it. So if you notice on the loan options, I like this lender because they give you an option to pay no points. And you see that the interest rate at 70% is 6.48. And then you see all the way down to where you can pay 4 points and get a 5.48 loan. Now, a lot of investors that we meet pick the top line. And I think it's an aversion to expenses. I picked the bottom line, and here's why. My strategy is to refinance these assets every 7 to 10 years for the next probably 10 years. And then we'll get to where we're only refinancing every 12 to 15. And then ultimately, as we get into our 60s, my wife and I will probably just refinance 1 or 2 houses a year, and we'll live off the borrowed capital versus trying to pay off the houses, because we need more expenses against the income. And by refinancing, you pay those expenses in year 1 from the closing costs and the points. And you also kind of start paying more interest which just helps out with your net income. And if you look at it, even if you make less money, if you're taxed a lot less, a lot of times it's a wash. And also, from a personal income situation, if you're distributing out proceeds and borrowed capital, it's all about playing the tax game, in my opinion. So we pick the bottom number and we go ahead and pay 4 points. It's a 548. It's a full point below the interest rate on the top 0 point. And it's because if you run it through an amortization table, which obviously we don't have time to run all these through amortization tables, what you find is it's about a 4.5, 5 year break even. But, if we're only planning on doing it every 7 years, then it's more than a break even. We end up doing pretty well. And so, that was this deal. If you notice in the notes there, it's DSCR constrained. That means the debt service coverage ratio. So again, I talked about being responsible and borrowing responsible capital. And that's what I mean. These deals, we don't over leverage them, right? We're not trying to get, 85% loan to values. We're not trying to get loans that aren't cash flow tested. We're really trying to be responsible with our leverage. And you also notice here that the pricing on this assumes a 5-year declining prepayment. So there you go, a 70% loan. Will be locked in, and this is with a 740 FICO score. So the mid FICO score on this borrower is 740. So that kind of, the rates do go up if you have credit below 740, if you have credit, in the 600s. And really and truly, if you get below 625, it's hard to get some of these 30-year loans. You may have to look at some of the adjustable rate options. But these are fixed rates, by the way. This is a 30-year fixed rate. And I think that's very important to notate because, what happened to me during the recession, and I fear what's going to happen to a lot of my friends that are buying houses right now and over leveraging, if you're using a bank, your rates are adjustable. If you're using a bank, you have a call feature in your rates, in your loans, where they could call your loans due. If you are borrowing on adjustable rate mortgages, I don't feel like this low interest rate environment is sustainable for our economy or our country over the long haul. So, and if you're borrowing the maximum you can cash flow based off of super low interest rates, when you get to, maybe a hyperinflationary period where finally someone increases interest rates, it can leave you in a pickle. And in April 2008, we had some loans called by a bank, and that's why we don't borrow money on our rental properties from banks anymore, because of the call features and the adjustable rates. This needs to be the most consistent and dependable part of my investment portfolio. So we go all 30-year fixed rates on our loans that don't have due on sale. They do have due on sale, that don't have call features, that don't have adjustment and review periods. We want it locked in, fixed, and we want to know that our income and our assets are protected for the long haul. So 548, 4 points. We borrowed 105 on this deal. I think, let's see. So, on this one, we're getting 90 grand out. Now this one in Garland, you notice, is debt service constrained up to, $119,000. So again, a 70% loan. Again, we're doing the 5-year prepays. Again, we're going to pay 4 points and get this thing down to 548. Super good rate. These are all in my LLC names. They are not in my personal names. These lenders that I use only loan to business entities, so we don't have to worry about personal asset protection. These are all in the company's name. and they are all individual loans. We do not do portfolio loans because the portfolio loans, we got them quoted. They either have a higher interest rate or they have like a 10-year provision or an interest-only provision or a 3-1 ARM, even if it's a 30-year loan, the ARMs. I haven't found a fixed portfolio loan below mid sevens on the percent scale. So I don't go that way. So here's that second Garland. You see that it actually was constrained to a max loan to value of 139,750 because of the debt service coverage ratio. Now, that may sound bad. You may be thinking, oh, it's a 65% loan to value. But what the case actually is here is this third house here that I bought in 2016. When I bought that house, it was only worth 125 to 150. It's experienced hyperinflation. It's really just kind of taken off. So if you look, the rents are super low compared to the value. And so that's why it's kind of misleading. We've owned this for 3 years. We probably would not buy this asset today as a rental property unless we could get a super good deal on it, right? It's a neighborhood that's now becoming more of a flip neighborhood because the rent to value ratio is out of line, which is good for me in the long term, but I just have to make sure I responsibly leverage so that I don't get overextended. So that's why on this house, you see it's constrained to 65 LTV, but 65 LTV today is actually, I think, worth more than the house was worth when I bought it 3 years ago. So, it works for me. So again, you look at this one, since it's a 65 LTV, my interest rate by buying the rate down is actually a 5.38. And so we're getting 139 out of this. We owe 71, right? So we're pulling a good chunk of change out of it as well. Now, this is a house that we just bought a couple months ago. I want to say we bought this it was April or May. Yeah, this one was April and the next one was May. So we bought this one in April. And it wasn't even finished being fixed up yet, but we were past the 90-day ownership mark, and we had a really good feeling that it was going to be leased by the time closing was ready. So we went ahead and added it into the package. And what I did here is I took all 5 of these to the same lender, and they're all 5, individual loans, but since I gave them 5 at a time, I was able to reduce the legal fee per property from like $9.95 down to like $5.95. So there's some nominal savings. I don't want to waste money, right? But and there's some efficiency in doing it all together. So and there's no limit. I can do as many of these as I want. So that's another thing. Whereas, the Fannie and Freddie stuff that people do, there's all those limits, and that's just not scalable. So again, it had the assumption that the property would be leased for $1,500. The property actually was leased for $1,600 over the weekend. So my property manager sent me the lease. We sent it over to the lender, and it's not too late in this process, depending on what the appraisal comes back, to actually borrow more capital. And maybe even get up to the 75%, because this lender will go up to 75%. It just depends. And, you have to cash flow. Now, this is probably the best rental property I've added to my portfolio ever. Yeah. So this is a house, nice 3-bedroom, 2-bath, 2-car garage, brick house on a corner lot, which was a good thing in this neighborhood, in Farmers Branch, which is a rapidly growing and appreciating landlocked northern suburb of North Dallas. You notice we're getting a 75 LTV because it's a rate and term refinance. What we did here, if you go back to this chart, you see that we owe 175. We bought it for 165. We went ahead and borrowed the other 10,000 from a second lien. so that we would have that, because I knew with the cash flow numbers, it looked like it could be a pretty good zero down, or not zero down, but very, very little down. So it's actually this deal, we're in it, I think 165 plus. I haven't got the final report from my property manager because we just now finished fixing it up. I think we spent like 15 grand getting it into service. And we may even, there's some rental comps that say 2,200 a month. So the nice thing about this one is we're really only in it for 165 plus 15, 180. And as you see here, you know, we're probably going to be able to pull almost all that money out at closing. But you see, there's a couple extra stipulations here in this one. So again, you know, you still have the 5, 4, 3, 2, 1 prepayment, but then you see the property. You see, it's got to be leased for 2,100, and the closing date has to be after August 6th. That way, we meet the 90-day seasoning. It's very important too that you understand. Talk to the lenders that you're talking with about, you know, hey, what is your seasoning requirement? And if you've owned the house for 2 months and they say it's 3 months, you just have to tell them, look, I don't want to. Please price my loan based off of closing, you know, after the 90-day mark, right? And they will, right? They just put it in their system that they can't close before that 90-day mark. Same thing with some of these portfolio lenders have 6 months seasoning, you know. So if you bring it, if that's the loan you want, tell them to price it at closing after the 6 month mark. I mean, because some of these portfolio lenders take forever anyway. Trust me, I used to run one, and you know, then you're not under the gun, and you just work towards that 6 month mark and close it day 6 month and 1. But this was, you know, we got a better rate on this, but the reason, okay, we got a better rate, but you notice it's higher. All these others are 5.48. The reason is because this is a 75% loan. So the more LTV you borrow, the higher the interest rate. And the reason is it gets more risky, right? So the more I loan you based off of the loan to value, the more risky. So the lenders, since these are cash flow based loans, they jack up the interest rate because they want to limit your ability to max out the LTV and be irresponsible. So, you know, if you can borrow 75% and still cash flow at 5.53, it's a good loan, right? But they're going to keep jacking up the interest rate as you go on. And I just say, you know, you don't really want to be over a 1.2, 1.25, 1.2 debt service coverage ratio, because it's just, to me, it's not responsible. So that's the scenarios. That's what I'm doing. I'm going to answer some questions in a minute. First, I do want to remind you that in a couple weeks, about 16 days, I'm hosting the REI Masterminds meeting in Rockwall, Texas. There are 11 seats left as of today. You can go to reimasterminds.com and apply. You need to own or have owned a rental property to be accepted. You need to have the ability and desire to buy more rental property. It is a landlord-only meeting. We're not talking about fix and flips. We're not talking about lead generation. We're talking about how to build wealth with real estate and helping each other with our problems and our businesses. That's a focus of mine. I've rededicated my professional career to focusing on my rental portfolio, and I want to be surrounded by people who are going to do the same thing. So reimasterminds.com. It's in Rockwall, Texas. 11 seats left. Apply today. I'll get back to you within 24 hours on whether you're accepted or not. And that is the end of my pitch. So questions. We will get to questions now. If you have questions, please go to the Q&A panel and start typing your questions. If you are on the Facebook Live, go ahead and just click over there and ask questions there. And let me get this question panel open. All right, so I am going to start at the top and work down. Thanks, Jim. Okay. John, I hope the webinar has helped. let me know if it hasn't, and I may be able to help you out in private. We started yet? Don't hear. Yep. Sorry. Yep. That was everybody that said they didn't hear. I was trying to refill my coffee. That's why I was a couple minutes late. All right. What is a reasonable cash flow? Would it be okay to just be positive by 100, or do you have a percentage or dollar number in your calculations? You know, the way I look at cash flow on my rental portfolio is I try to stay at a 1-2 debt service coverage ratio. So I don't look at the nominal dollars as much as the true net cash flow as a percentage. So right now, my average rents on my portfolio are between 12 and 1,700. I haven't run an average recently. And typically, we're cash flowing about 250 to 400, somewhere in there per property. And that's net after my assumptions of taxes, after my assumptions of vacancy, maintenance, turnover cost. And I do use a property manager. Someone had asked that. So it's really after all of my assumptions. So I would answer your question as, if you're positive by 100 true net cash after reserves, after taxes, yeah, I think that's an acceptable deal, as long as it's not like a $2,000 or $3,000 a month rental, right? If the higher the rental amount, so like on a $1,200 a month rental, I'd say that would be great if it was a net cash flow. If it wasn't, one of those, oh well, by the time I paid my mortgage, taxes, and insurance, I got $100 left, right? Because that would actually truly be a negative cash flow, because by the time you add in vacancy, maintenance, repairs, management, turnover cost, that's going to eat up more than $100. So I hope that helped. For your rentals, do you self-manage or use a property management company? Trying to get an idea of your methods. So I used to self-manage. I've done it, in 20 years, I've gone back and forth between 95 different strategies. I'll tell you, it was a glorious day, the day the last tenant moved out of a house that knew who I was and had my cell phone number. So we do our best to hide our identity in our corporate names and in our rental property names. And when we're having appraisals, typically I'll meet the appraiser and I'll just say that I'm an inspector, and literally the tenants have no idea who I am. They typically think I'm a contractor that works for the owner of the property or the property management company in most cases. And it's kind of funny. They'll tell you everything. And I just, oh yeah, you'll have to call the property manager. You'll have to call the property manager. Had one tenant a couple months ago when I was there to meet him for the refinance appraisal that starts telling me about how the property manager doesn't even know that he has a dog that he keeps there on the weekends and all that. And I'm like, oh, okay, yeah. Well, make sure you don't tear up the property. I leave the property and I send my property manager a text message like, you better take care of this right now. So I use a property manager because I'm a firm believer that your investment should not call you. There was a house, you'll enjoy this story. There was a house last month that on my monthly report, it showed it went vacant. It's actually one that's in this refi. And I got all wigged out and I called the property manager. I was like, oh, I didn't know what happened. He goes, oh no, Tim, their 2-year lease was up. They gave notice. We've already rented it for like $300 more a month. I was like, oh, great. So that's why I use a property manager. These are all individual loans. They are not portfolio loans. If borrowing from a bank, how are you borrowing on these 30-year? If not borrowing from a bank, how are you borrowing on these 30-year loans? So most banks do not do 30-year loans. They may give you a 30-year amortization, but typically it's a 5 to 10-year loan, maybe a 15 with a call feature that means anytime there's a renewable period, typically the lender reserves the right to call the loan as well. I am borrowing these from, I've got a list of lenders. If you'll shoot me an email, I will connect you. Let's see, do you have a limited number? Nope, these are unlimited. You can do as many as you want through your LLC or your C Corp. I don't think they'll do a limited liability company. Can you share the names of some of the companies you look at for finance? Absolutely, Terry. If you'll just send me an email, I'll reply and introduce you to the loan officer of my choice at each place. I'm guessing you're maxed out on your limit of Fannie Mae 10 houses. If you were not, would you still do this kind of business loan rather than keeping your name? Absolutely. So I am not maxed out in any Fannie Mae product. I have 0 Fannie Mae or Freddie Mac or agency loans in my name. And I would obviously still do these type of loans because for me, this is the long game, right? This is where we want to have millions and millions of dollars of net worth. This is where we want to have tens of thousands of dollars in net cash flow every month. And to save a point of interest, I don't want to put all that at risk, right? So, I mean, and so I would rather not have, so everything's in my company name. The companies are properly maintained, and that is, it's very necessary in my opinion. So I would not and will not take a loan out or title a house in my personal name. That's just personal opinion, you know. The minimum DSCR, they really go by a property debt to income ratio. Let me show you. I think I can get it up over here. Let's see. Yeah, you see this PITIA, principal, interest, taxes, insurance, and associations. So there's a formula that they use that factors the debt to income of the property. I think they're going up to 80% right now. Tiger, if you'll email me, I've got a new document from this lender that I use that kind of breaks the program down pretty well. The lender on this is RCN, and I use a guy named Matt. If you shoot me an email, I'm happy to introduce you to him. What are the names of the lender? Everybody want to? I'm using RCN. I quoted Lima One. I quoted Colony. I quoted Vizio. I quoted the bank. I quoted RCN. I quoted Constructive. It seems like I quoted someone else. But if you shoot me an email, Mark, I'm happy to directly connect you with the guy I use. How can you best leverage rentals that are paid off? Refinance them. I mean, imagine, if you've got a house paid off and you can pull $100,000 tax-free out of it, not only will you reduce your tax burden on an going forward because you'll have interest deductions and you'll have closing costs in year one. I'm telling you, at B2R, we did $1 billion worth of these things, and almost every investor was able to double their portfolio by releveraging. And when you double, once you get to 10 houses, if you're on this call and you don't have 10, once you get to 10 houses, this business gets super easy because it's consistent. It's less likely that you're going to have a big vacancy issue, right? And so I say absolutely go refinance. Do never sell a house again, especially if it's a bad house. If it's a house that's always vacant, if it's a house that has residual repair problems, get rid of that sucker. And then go buy a good house on an interior lot, that doesn't have anything crazy about it, that's going to attract good quality. We leased that house in Grand Prairie to someone that's worked for their job for 7 years and has a 700 FICO score. The culture of tenants have changed in America. And if you buy nice houses, you will find nice, good people that want to live in a good, nice house. Anyway, that was a rant. Sorry. Yeah, these are all single family rental. As someone said, this seems to be mostly SFR refis, similarity to MFs, multifamilies. There's a couple lenders that we work with that do some multifamily bridge loans. There's a couple lenders that we work with that are doing kind of smaller, non-conforming, $200,000 to $300,000 refinances for multifamily. Carlos, if you drop me an email, I can connect you. If you're looking for like something that's a nicer, larger complex, Old Capital is probably the biggest lender that I know of in the space right now that I see everybody talking about. Through the financial plan. Oh, can you walk us through the financial plan? You taking money and buying more, just living on the loan. I was trying to buy one every year, but life got in the way. on rentals, was looking at generating 200 net a month, getting tough to find good deals in this market. Yeah, so I'm absolutely redeploying this capital at this stage of my life into new assets. So we're refinancing these 5. They're all closing in the next couple weeks. And we have already identified 2 more rentals, and we will add at least 5. But so the total amount we're getting back on this after closing costs and everything, I think is like $225,000. I can't remember. But we kind of budget $25,000 per property as we're getting into them. Some of them are 15, some of them are 40. It just depends. Accidents happen. But I mean, if you just take 25,000, right, at 200,000, forget the other 25,000, right? Because we do put some back for reserves as we increase our leverage point. To me, it should get us at least 6, maybe 7. Depends on how nice of asset we go after. But yeah, so borrowing on 5 should get me at least 5, most likely 7 newer houses that, our criteria has changed a lot. Some of these are 3, 1.5, 4, 1.5. Some of these are older houses. We're really going for more of a Class A type asset these days. Explain the declining prepayment penalty. Not familiar with the term. Okay. So if you pay the loan off in year 1, you owe 5%. If you pay the loan off, you owe 5%. There's a 5% prepayment penalty. In year 2, there's a 4% prepayment penalty. In year 3, there's a 3% prepayment penalty. In year 4, there's a 2% prepayment penalty. And in year 5, there's a 1% prepayment penalty. So basically, every year, the prepayment penalty, it starts at 5 and goes down 1 point a year until the 5th year. And after that, there's no prepayment penalty. That is just to protect the income stream. So I'll go kind of geeky on you. The securitizations in the single family rental space are still relatively new. We did the first one to regular borrowers in April of 2014. They first single asset, single loan securitization wasn't done until 2016. So the rating agencies and the bond investors don't know how to predict when these loans will pay off. So like a traditional Fannie Mae, Freddie Mac mortgage, they know that the average loan will be on the books for 7 years. They just know it, right? So these prepayments are in there now to protect the bond investors' projected income. As the industry continues to mature and advance, what will happen is you'll start to see some of these prepayment penalties go away, but just like they have in Great Britain. But for now, it's a 5-year declining. Like I said, my plan is to get to where we're only refinancing every 15 or 20 years per asset. Because then if you cull your portfolio and you end up with, let's just say, 40 rental properties and you're refinancing 2 a year, that puts you on a 20-year cycle. If you're waiting 20 years, you're probably pulling $100,000 out a piece. So then you got, $200,000 cash flow to buy more. And then eventually when you retire, you actually start living off that borrowed money. Because if you get $200,000, it's an inflation indexed annuity that appreciates and has an underlying asset base. And the nice thing is if you can pull $200,000 a year out of your annuity and you have, cash flow, say you're making $300 per on 50 houses, you got $15,000 a month. It doesn't, I'm not a rocket scientist, but if you design a life that you can't live off of $25,000, $30,000 a month, maybe you should design a different life. And that's not even factoring in rent appreciation over 20 years. Hope I answered your question. I have 4 single family properties and 4 individual LLCs. I need to refinance these and get out of adjustable rate mortgages. Who can I use? I didn't think you could get a fixed rate with an LLC. Well, you can, Tracy. I recommend you talk to Matt, depending on the location of your properties. I may recommend someone else. If you'll shoot me an email, I'm happy to introduce you. All right, fairly new and one rental. Have my third project house under contract and want to get more rentals, but getting more is a little bit of a challenge at the moment, but would like to go to the masterminds. My ultimate goal is for rentals to live off retirement. Absolutely, John. And that type of mentality is exactly the kind of person I want to be sitting in a room with all weekend on the 17th. And I'm going to feed you barbecue. We're going to go out. Friday night, we got a big happy hour we're going to do at the hotel. We're going to eat mastermind all day Saturday, eat some barbecue, and then we're going to go out on the lake on a little kind of dinner cruise that night. And then that Saturday night, and then Sunday morning, we'll all have brunch as everybody leaves. But I hope you decide to come. You got a 100% guarantee that if you're not happy, I'll give you your money back. If I have 30 properties, what would be a good management fee to pay per month for property management? It's a great question, Terry. I think it depends on the average rents of your property. If you have very expensive properties, say that you're getting $2,000 a month in rent, then I would say maybe you want to talk to Renters Warehouse. With 30 properties, I can do a direct introduction to their president of portfolio services, Anthony Kazazian. He's a good friend of mine. He's their chief investment officer, and he worked with me at B2R Finance. He's a great dude, and they'll give you a flat fee per property, right? So on a $2,000 a month property, if you're paying 10%, that's $200. Well, they'll do it for less than $100 a month, right? So now, okay, well, great. If you got $1,000 a month property and they're doing it for $100 a month, maybe not so great. Maybe you go around to some local folks and you try to get them to negotiate a 6 to 8%. I personally pay 8%. I use a property manager that manages over 3,000 assets in the Dallas-Fort Worth area, and he owns 2,000 of those. So I pick up a lot of economies of scale by working with him. Do mortgage lenders have call features as well? Some do, some don't. A lot of times if there's an ARM, adjustable rate mortgage, you need to go find your loan documents and look in the section where it talks about renewing the annual and anniversary and when the rate resets. In that paragraph, in a lot of bank docs, you will find a little sentence that's like, oh, hey, by the way, at this time, upon the anniversary date, this loan may be called due in full. And if you're listening to this call right now, and you're thinking, wow, my bank doesn't do that, and you haven't looked for it, I'd almost bet you money that you're wrong. A good friend of mine that has a lot of assets told me, oh, no, my bank doesn't do that. And then 2 weeks later, he calls me. He's like, holy crap, my bank does that. And then he went and sat down with them on the next refinance and negotiated that sentence out of the loan docs, which is something you can do. But no, these 30-year fixed do not have call features. I mean, they do, like if you default, right? They do, if you break the loan docs, they can call it, but not just on an anniversary date. But some of the ARMs, even the national ARMs do. You got to read your loan docs. How many other lenders have you shopped were competitive close to these terms you received? How many different lenders do you currently have notes with your rental portfolio? What is your opinion on shorter AM periods, 15, 20, 25? Very good question, Jack. So here's the interesting thing. I shopped 6 lenders. A lot of them came back in the mid to high 6s. Some of them came back in the 7s. Some of them were interest only in the 7s, which then got me more cash flow. More capital, but I didn't feel right about it. The portfolio loans were a little lower, but again, the portfolio loans, like Colony had the best terms for a 10-year portfolio loan, but I don't like the balloon payment. It just scares the bejesus out of me that, if I had $1 million balloon payment that came up in 2008, I'd have been hosed, right? So, call me gun shy, whatever. And then, with regards to shorter AM periods, I used to do that, right? I used to put everything on 10-year notes. I used to put everything on 10, 15-year notes. I used to really be focused on trying to pay off these houses. And I don't ever want to own a house free and clear anymore. I really don't. Except for my personal residence. That's what I want to own free and clear, my homestead property. These other houses, I prefer them to be leveraged. I prefer to use that leverage to buy more assets. I prefer a 30-year loan where I cash flow more, where I can borrow more, where I can buy more, where I can then lock it in for a 30-year period. And rents are going to go up, values are going to go up. And if my payment doesn't, tax increases obviously are eating up a big chunk of these rental increases. But now I used to use all 10 and 15s and I was like, I'm going to own 40 free and clear. I've just changed. The billionaire was right. The power of leverage allows you to expand and gain critical mass. And that critical mass allows you to have peace of mind. Would you be willing to share the name of your property manager? I have 27 rentals. Yeah, Mark, if you'll just email me, I don't want to say it out loud. It is, Scott Belsley, but I'm not sure if he's taken on any new clients. He's got some portfolio size restrictions. If you drop me an email, I'll be happy to reply and introduce you to his chief of operations, Sam, and he'll talk to you. Would you be willing to share the name of your property? I think I just answered it. Oh yeah. Oops. What does your property management company charge you? Right now we're at 8%. For lender list, Carlos, yeah, I'm going to forget to come back and find this chat dialogue. Do me a favor and send it back. Just email me, tim@timheritage.com. That way I can reply and get it to you fast. Roy says, should I include utilities included in a duplex rent payment? You should make sure that they're going to look at the lease and look for any all bill paid situations. So if you're receiving utilities in the rent, you need to include it in the gross rent, but make sure that you itemize it out as an expense and let the lender know at the beginning, because you don't want to change the loan terms to the negative in the middle of the transaction. Just be upfront. Do you have a minimum net positive cash flow requirement on a rental acquisition? I don't really look at it that way, right? I look at houses as a 12% gross yield. So let's just say, for easy math, if I'm buying it for 80 and it needs 20, as long as I can rent it for 1,000, that's kind of step one. If I'm buying it for 170 and it needs 30 and I can rent it for 2,000, that's probably going to work. Then I plug it into a rental calculator. Here, I'll show you. Yeah, we're going to go a little long today. I am recording this. So here's my Farmer's Branch house, right? All right, so here's the Farmer's Branch house, right? I figured it was worth $240. I figured it would rent for $2,100. I've got an auto calc on the insurance. I don't remember what the taxes were. Let's just say they were $6,000. I'm trying to invest $25,000 and it needed $15,000 in work, right? So down at the bottom, right, you see the way I set this up, I'm trying to keep my property debt to income ratio at or below 80%. So on this house, it told me that I could buy it for 181 and still be in it for that 196, which would cover, my target is $25,000 cash invested in the asset. So that's really, I don't look at the net cash flow, I look at the property debt to income ratio, right? So I'm basically looking for a 20% margin on my expenses. So in this deal, I should cash flow $400 or $500 a month. How do you find the houses you buy? It's kind of funny. Of the last 4 rental properties we've done, 2 have come from wholesale, my advertising and buying them from my own company. And then 2 have come off of MLS. My wife has gotten really good at using this spreadsheet and looking for houses that need kind of tender love and care. They're not necessarily investor houses, but since we can pay 80-85%, as long as it's a cash flow, what you do is you search neighborhoods based off this is going to sound really complex, and I can do another talk about it some other time. But if you take the dollar per square foot in rent and you divide it by the dollar square foot in sales prices for the area, right? So if the house is going for, a dollar a foot in rent divided by 100, right, you're at the 1% rule if it's selling for 100 a foot. So that kind of helps you target the areas and then make offers kind of based off the cash flow, which gets you to a 12% gross yield. And most of the times in Dallas-Fort Worth, that's where I buy, you can get the 12% gross yield will get you to the 80% property debt to income ratio. You target certain ARVs for rentals. Are you seeing certain ARVs appreciate faster than others? For instance, sub 200. Yeah, absolutely, Tiger. I mean, I used to want the below 100. Now we've been working on getting rid of those. And really and truly, in my opinion, anything from like 125 to 200, 250 is kind of a candidate. And then it's just going to we just got to look at the rents, right? Because if I can get a 12% gross yield, I keep saying that, it's going to work. So I would tell you right now, most of my properties are, I would say the average value in the rental portfolio is probably 175, 180. It's going up. We're all interior neighborhoods, no white elephant issues, everything. We've gotten rid of everything except the 3-bedroom, 2-bath, 2-car garage, brick houses. Except for the one that we're refinancing in Dallas right now. It's kind of a nostalgic thing. My wife bought it. It was the first rental she ever bought, and it was a VA non-qualifying assumable loan back in a long time ago. I hope that helped. Terry Swan, Terry, this might be too personal, but do you depend on your rentals for monthly living cash flow, or is it long-term money strategy? Yeah, we don't touch it, Terry. That's a great question, and it's not too personal. This is the kind of conversation I like to have. We don't touch it. We don't use the rental money or the refinances for anything right now. And the goal is to keep it that way till our kids are out of high school, which my oldest son reports to college football this weekend. My youngest son's about to start 4th grade. So we got 8 or 9 years left. After that, the plan is to have 40 to 50 really super quality houses. And and it evolves. We sell houses, we buy the wrong house. So, if you got 40 to 50 super good houses and you've culled through the junk and you've got advantageous financing, at that point, Terry, the idea is to retire and move to the Texas Hill Country and live off of the cash flow and the refinances instead of the flipping and all that. I don't like flipping houses. How do you determine future reserves? That's a great question. We used to do a percentage of debt. Now it's really more a dollar amount. Up until this point, it's been 50,000. Portfolio is getting to where my wife and I were talking the other day, probably want to move that up to 75,000. Eventually it'll probably be 100,000. It's more about kind of that nominal dollar of figuring out like what's the most we could have to spend. And I think that it stops being a percentage once you have enough houses, right? Because once you have enough houses, then you have economies of scale and, you can have a dollar amount instead of a percentage. If you're just starting out, I'd say 10%. Okay. Someone asked, how are you only needing 25,000 to purchase new properties, paying cash, and the 25K is closing, rehab, et cetera? Yeah. So it's hard money, right? I mean, we're using private lenders, not hard money. We use some private lenders. And so we buy houses that, we can get for 65 to 80%. And we're typically borrowing, we've got a line of credit open with an acquisition where we get 100% financing up to 70%. So we borrow 70% of it on our line of credit. And then we turn around and put the rest cash in. A lot of times what we'll do is we'll loan money to the acquisition company from like a limited partnership or a family trust. That way, when we refinance, we actually have it's a rate and term instead of a cash out. Does it make sense, John? I hope so. Some of the abbreviations not familiar with. How can I get more educated on this terminology? Recommendations. This is going to sound like awful. I'm going to say Google, but email me. Come to the mastermind. If you want, what I'll do is I'll send out the PDF version of these slides. And if you want, shoot me an email and I'm happy to answer any questions, Ernest. Thanks. Oh, you're welcome. How much down payment can you usually pay for a property? I'm surprised you can get 5 to 6 more houses with $200K. Is this because you're going through a lender, not a bank? Yes, absolutely. Well, I mean, first off, I'm financing the acquisitions using a line of credit that I set up through actually the company I sold my lending company to. They've got a great line of credit product. So we get 70% financing for 8% interest and 2% origination. And it's 100% loan to cost. So if we're buying at 85% loan to cost, we're only putting 10 to 15% into it. Like I just said, a lot of times we're borrowing that capital either through private lenders or a family trust in order to create a 75% loan against the house, because we know that we can refinance it as long as it cash flows. Some of them, the cash flow we know is going to limit us to 70%. So that's 70, and we're just going to pay the rehab out of pocket. So that's what we're doing. How much down payment you? Oh, I just answered that. What do you think about executive home rentals, i.e., $600,000-$700,000 homes? Very good question, Terry. So I'm actually, if you may be able to hear in the background, there's a saw that keeps going off. I'm in my new home office that's actually at my mother-in-law's house. So we are in the process of building them a house out back that they're going to live in, and then we're going to move into their house and help take care of them in their latter years. And then our other house, our primary residence, we're actually going to turn that into not an executive rental, but a corporate housing. So that house is kind of close to the dollar amount you're talking about. And we're going to do corporate housing, I think a 90-day minimum. And we've got almost a waiting list just by talking to a couple realtors, because there's not much of that in Rockwall. And we think there's a great opportunity to provide, all bills paid, fully furnished properties. And so that's what we're doing. No, I do not use RCN for the initial acquisitions loan. I was worried that in time the pieces you could take. Do you use RCN for initial acquisition loans too? No. I thought like you as well, pay off everything. So this is different. I was worried that in time the pieces you could take out would be less as the balance grew, but that is offset again by acquiring more properties. Yeah, absolutely. You got it. I don't recommend you refinance and spend the money on a new car unless you've already got enough properties. Oh man, Jim asked, do you own or finance your properties or just pure rentals? One of the worst decisions I ever made as an investor was owner financing my a bunch of houses in 08, 09, because you lose the appreciation, just, pure and simple. Now, I do still owner finance some houses, but the owner finance ones are the non-conforming assets. So if I find a house that doesn't fit my normal rental criteria, but is a great deal and looks like I can get kind of a zero down type thing going. So like there's one I did recently. I bought it for 105. I spent $1,000 cleaning it out. I owner financed it for 140. I got 15 grand down at 9%. And so now I got a $125,000 note at 9%. I bought it for 105. I just reduced the principal to my private lender. So it's like a 20-something% return. And what I'll do, my strategy on my owner finance is suck out the rent for 8 years. The interest for 8 years, and then sell the note. But you have to understand, owner finance property is not an investment. It is income. Period. End of story. You can't argue with me. And, we lost millions of dollars in equity from the houses that we own or financed during the downturn. I don't regret it. We had to do it back then. We were just running out of cash and getting those cash down payments and having less turnover and vacancy seemed like the right thing. Looking back, we cost ourselves millions of dollars. So we sold all the notes and redeployed the assets into better rental properties. You live, you learn, and you move on. Okay. Oh my gosh, there's only 2 left. Will the mastermind be focused on property management, or will financing, buying be a large part? No. So the mastermind is going to be focused on all aspects of landlording. So we're going to talk about property management. We're going to talk about tenant laws. We're going to talk about financing. We're going to talk about property selection criteria. We're going to break people into groups. So that's the power of having 50 people from across the nation that are active landlords come together. You're able to kind of, make sure that people are really focused and you're learning, right? Because you may learn something that someone's doing in the Pacific Northwest that actually would work well here, especially since they're all moving here in Dallas. So it's going to be everything. And so there'll be 3 case studies as well. So what'll happen is 3 of the attending parties will have an opportunity to take 20 minutes and present their business ideas and plans, right? And they may be passionate about self-management, and they may have all the assets, and they may be using Propertyware and have a template for something. That's the power of the mastermind. So it's going to be about everything, to answer your question, honestly. Terry says, is there any tricks to move forward from a portfolio to single financing? If you already have a portfolio loan, you got to watch out and look at your all the portfolio loans that we did back in the day at B2R had yield maintenance, and the yield maintenance was very, very expensive. Typically, you only had like the last 6 months of the loan, or 3 to 6 months of the loan, where you didn't have a prepayment penalty of yield maintenance. Highly recommend you go back and reference that. And then, you just call some of these single asset lenders and get a quote. Have you ever used self-directed IRA to purchase rentals? Yes, I have. And yes, they've been sold. And yes, I've closed my self-directed IRA. I felt like it was just too cumbersome. And I'm just a simple person. I like to make money, and I like to not have to follow anyone else's rules. So it's, some people are great at it. I'm not. So I quit doing it. Do you ever buy a foreclosure auction? I've never bought a single house at a foreclosure auction. I cannot force myself to do anything sight unseen, and I don't like losing, and I know that about myself. So I know I cannot go into a competitive bidding environment, or I will probably pay way too much and lose money, and then my wife will murder me. So yeah, I honestly have been a little lax of late investing. So I'm hoping that this mastermind could reignite and provide an actionable plan to implement now and future growth. I'm self-employed now, so cash flow cash flow is a living consideration, though, which may impact implementation. Look, I think everybody has a cash flow situation and a living expense situation, and you have to break your activities daily, weekly, monthly into, what are you focused on? What are you passionate about? And so you can do things to reduce your income, your living expenses, or you can just do things to increase your income. And I always vote towards increasing income, but reducing expenses can be key as well. That's that. Great reconnecting with you as well. Please join the mastermind. We would love to have you. That is it. Wow. 46:55 questions. We are good to go. I'm at an hour and 14 minutes. I'm going to end the recording. I really, really, really appreciate your time, taking the time to listen to me talk. I hope that this was helpful. Send me an email, tim@timharridge.com. Check out timharridge.com. Register for REI Masterminds. Listen to my podcast, the Business and Barbecue Podcast. Search iTunes for Tim Harridge. That's it for today. Hope everybody has a great Oh, yes, the replay will be available. You can look at my Facebook page right now, and it's on there, and you'll be able to watch it there. Or you can go to my YouTube channel after today, and it will be posted there. We'll send out an email. That's all the time I have. Until next time, everybody, keep cooking.